Warren Buffett, also known as the Oracle of Omaha, is a name that resonates with success in the world of investing. His story is a testament to the power of patience, discipline, and intelligent decision-making. Let's take a brief journey through time to understand the man behind the billions. Born in the heart of America, Omaha, Nebraska, in 1930, Buffett's relationship with money started at an early age. From selling chewing gum and Coca-Cola door-to-door to delivering newspapers, his entrepreneurial spirit was evident. But it was his fascination with numbers and probability that would lead him down the path to becoming one of the world's most successful investors. Buffett's investment career took off when he started working with Benjamin Graham, the father of value investing, in his early 20s. It was Graham who instilled in Buffett the principles of investing in undervalued companies. Buffett's knack for identifying such gems and the patience to wait for the market to recognize their true value turned out to be a winning strategy. Over the years, Buffett's company, Berkshire Hathaway, has accumulated a diverse portfolio of businesses, from insurance to candy companies, railroads to furniture stores. His investment style is a masterclass in simplicity and discipline. Unlike the high-speed, high-stakes world of day trading and speculation, Buffett's approach is methodical, long-term, and based on solid fundamentals. It's not about timing the market, but time in the market. Buffett's success isn't just about his acumen for picking winning stocks, it's also about his philosophy of life. He believes in living frugally, in giving generously, and in the power of compound interest. His life is a lesson in how to build wealth sustainably and ethically. Now you too can learn from the master. Stick around as we delve into his top 5 investment tips for 2024. Each tip is a nugget of wisdom, honed over decades of experience and proven by the test of time. They may just be the keys to unlock your financial future. Buffett's first tip is as simple as it is profound: invest in what you know. This principle is the cornerstone of his investment philosophy. He firmly believes that understanding a business is key to making informed investment decisions. Let's delve a bit deeper into this concept. By investing in what you know, you're not just blindly throwing your money into a company because its stock price is going up, or because it's the latest buzzword in the financial world. Instead, you're making an informed decision based on your understanding of the company's business model, its products or services, and its position in the industry. Think of it this way: would you buy a car without knowing anything about its features, performance, or reliability? Probably not. The same logic applies to investing. Understanding the ins and outs of a company can help you gauge its potential for growth and assess the risks involved. Now you might be wondering, how has Buffett applied this principle in his own investments? A classic example is his investment in the Coca-Cola Company. Buffett knew the company well. He understood its business model, recognized the power of its brand, and appreciated its solid financials. His investment in Coca-Cola in the late 80s has paid off handsomely, proving the efficacy of this approach. But remember, investing in what you know doesn't mean restricting yourself to companies in your professional field or personal interests. It means dedicating time and effort to learn about different industries and businesses. It's about expanding your circle of competence, as Buffett calls it. So, before you make your next investment, ask yourself, do I understand this business? If the answer is no, it might be time to hit the books or scour the internet for information. In short, knowledge is power in investing. When you understand a company, you're better equipped to make sound investment decisions. And as history has shown us, this approach can lead to impressive returns. So follow in the footsteps of Warren Buffett, invest in what you know. Buffett's second piece of advice is a cautionary one. Be fearful when others are greedy. In essence, this advice is about observing market sentiment, a collective mood that can often lead to overpriced assets. Think of it as the emotional pulse of the market, a barometer of the investing public's overall attitude toward a particular investment or the market as a whole. Let's take a journey back to the late 90s during the dot-com boom. The market sentiment was overwhelmingly positive, with investors pouring money into any company with a .com in its name, regardless of its fundamentals. But as we all know, this led to a massive bubble, which eventually burst, causing many to lose their fortunes. Warren Buffett, however, sat on the sidelines during this period, refusing to invest in tech stocks he didn't understand. He was fearful when others were greedy, and his caution paid off. When the bubble burst, his portfolio remained largely unscathed, and he had plenty of cash on hand to invest in quality companies at bargain prices. Fast forward to the financial crisis of 2008. Again, the market sentiment was overwhelmingly negative, with many fleeing the market in panic. But Buffett saw this as an opportunity. He invested billions in companies like Goldman Sachs and General Electric, buying when others were selling, and once again, his contrarian approach paid off. But how can we apply this advice in today's market? It's all about staying vigilant, observing the mood of the market and not getting swept up in the euphoria or panic. When everyone is buying, it might be time to take a step back, assess the situation, and perhaps even consider selling. Conversely, when everyone is selling, it might be an opportune time to buy. So, the next time you see headlines proclaiming the next big thing or warning of impending doom, remember Buffett's advice. Don't follow the crowd. Be fearful when others are greedy, and greedy when others are fearful. Remember, the market is a pendulum that swings between unsustainable optimism and unjustified pessimism. Buffett's third tip focuses on quality over quantity. It's far better to buy a wonderful company at a fair price. In the world of investing, this mantra rings true. It's easy to be tempted by a company with a low stock price, but as Warren Buffett advises, it's the quality of the company that truly matters. This doesn't mean that we should disregard the price entirely, but rather, we should prioritize the company's fundamentals and long-term growth prospects. Let's break this down. What does it mean to be a wonderful company? Well, according to Buffett, a wonderful company is one that has strong competitive advantages, solid management, and a proven track record of profitability. It's the kind of company that can weather economic storms and come out stronger on the other side. Take, for example, Buffett's long-standing investment in Coca-Cola. Despite its relatively high price when he first invested, Buffett saw the enduring value in the company's strong brand and global reach. Over the years, this investment has proved to be a wise one, with Coca-Cola consistently delivering solid returns. Similarly, Buffett's investment in American Express, another wonderful company, was driven by its robust business model and impressive market share. Despite facing numerous challenges over the years, American Express has demonstrated resilience and an ability to adapt, justifying Buffett's faith in the company. But what about the fair price? Buffett isn't suggesting we pay any price for a wonderful company. The price should be reasonable, taking into account the company's future earnings potential. A fair price is one that offers good value for money, considering the quality of the company. This approach underscores the importance of patience in investing. It's about waiting for the right opportunity to buy a wonderful company at a fair price, rather than rushing in to buy a mediocre company because it seems cheap. So, the next time you're considering an investment, remember Buffett's wise words. In investing, it's not about getting the cheapest deal, but getting value for your money. Buffett's fourth tip highlights the power of patience. Our favorite holding period is forever. This is a statement that underlines the importance of long-term investing in the philosophy of Warren Buffett. The beauty of long-term investing lies in its ability to produce compounding returns. Compounding is the process in which an asset's earnings, from either capital gains or interest, are reinvested to generate additional earnings over time. This means that the longer you hold an investment, the more potential it has to grow exponentially. Consider Warren Buffett's long-standing investments in companies like Coca-Cola and American Express. These investments have been held for decades, and over time, they have significantly multiplied in value. The key to this success? Patience. Patience allows an investor to ride out market volatility, and more importantly, it gives your investments the necessary time to grow and yield substantial returns. So remember, in the world of investing, patience truly is a virtue. Buffett's fifth and final tip is perhaps the most important one. The best investment you can make is in yourself. This isn't just a feel-good statement, it's a guiding principle that has shaped Buffett's illustrious career. Consider this. The world of finance is dynamic, constantly shifting and evolving. To navigate these choppy waters, one needs to be adaptable, a lifelong learner. Buffett, despite his vast experience and knowledge, is known for reading 5 to 6 hours each day. This isn't just about staying informed, it's about growing, expanding horizons, and refining skills. But investing in yourself goes beyond acquiring knowledge. It's about cultivating good habits, nurturing emotional intelligence, and fostering resilience. It's about understanding that setbacks are not failures, but opportunities for growth. Buffett has weathered numerous financial storms, each time emerging stronger, more savvy, and more determined. So as you embark on your investment journey, remember Buffett's wise words. The more you learn, the more you earn. Remember, investing in yourself yields the highest returns. So, there you have it. The top 5 investment tips from Warren Buffett. Let's quickly recap. First, invest in what you know. Understand the business before putting your money into it. Second, be fearful when others are greedy. Don't follow the crowd blindly. Be contrarian when it makes sense. Third, buy a wonderful company at a fair price. Good quality businesses will yield good returns over time. Fourth, hold on to your investments for as long as possible. Patience pays in the long run. And finally, the best investment you can make is in yourself. Never stop learning and improving. These principles have guided one of the most successful investors in history, and they can guide you too. They stress the importance of knowledge, patience, and self-improvement. Don't forget to like, comment, and subscribe for more money-making content. And remember, the best time to start investing is now.